Hello everyone, welcome back to the channel. This is Fair Value Finder. I have been away for a little bit. I had a work conference in Vegas for Microsoft, and after that, I am going to look into Microsoft again with all of the growth rates that I've seen out of them and all of the new products that they are currently working on, how much of the S&P relies on their software and programs, but also VICI. VICI owns a lot of those Vegas properties, rents them out to the casinos. I'm long Caesars as well. I love Caesars. Definitely reiterated why it is one of my larger holdings and one of the companies that I believe in for the long term. But for VICI, I've talked about them maybe twice before on the channel. I know last year came up with a fair value right around $40 and a growth rate of about 8%. It was like 8.3. And this time around, I'm coming up with 46.5 for the fair value and a growth rate of just shy of 8%. After you factor in the dividend, of course. The dividend is a big contributor here. I mean, you can see from the analyst projections, revenue growth, not very big, but we'll get to all that. Earnings yield, currently 8.16%. We'd want $1.58 in earnings for what we're paying, and we are definitely getting that out of the stock. We are seeing last year 256, this year 276 is expected, and next year 282. So value-wise, looking pretty good. They're usually trading around a 12 PE. There was one point where the valuation got pretty inflated. They went up to a 23, but 12 is definitely fair for them here. Currently, they're shy of that. They are definitely a little bit lower than how the market typically values them. Cash flows are super strong, as you would expect for a company like this. Dividend are really high. They're legally required to pay out the majority of their earnings as a dividend since they're a REIT, a real estate investment trust. So I expect that to just continue to grow, at least in line with their earnings. ROE looks super good, 10%. ROI maybe a little low, 5. ROA okay at 6. But the ROE is not inflated really. The debt to equity 0.7, which is very good for a real estate company where you're dealing with a lot of debt and renting it out, and they have a strong balance sheet for what they do. Margins, of course, there's just admin work for the most part that goes into their cost of goods, and net margins super strong, 62 to 70%. This last year they came in at 69.6. So definitely a balance sheet that I like. I've said before, this is probably one of my favorite REITs, and I do like to have a REIT in the portfolio because it's really strong dividend cash flow, especially since I have a background in the real estate space. Probably about half my income in total comes from real estate, and a good portion of my net worth is invested in real estate. Revenue is definitely slowing. They had some good, strong years of growth, but analysts aren't expecting much. 2.86, 2.69. We'd hope that they come in above that. We'll see. If they're not getting more properties, then that's probably not going to grow, really. It depends on the terms that they have on their current contracts and if they come in with a hike every year to the rents. Share count, 3%. I mean, this last year they came in at 3.25. It's definitely slowing down as they have more shares. They're a special case where we actually kind of like to see the share count growing because that means that they can get cheap cash to go and invest in more properties to grow the revenues and the earnings and dividend and everything else. So don't have an issue with that like we do with most companies because of the nature of their business. Cash flows are strong. They typically have been. In fact, I think this 7% that I have here might be a little high. I was looking at historically. They came in at 6.7 in the last 2 years, but they're currently at 61.5. 64 is their average. If they come in at 5% compound annual growth, I mean, that'd get them to 68 in 5 years. So that's probably a little excessive. 3 kind of keeps them where they're at with the revenue growth. So I'd say 4, get them back up to a higher point, more in line with what we've seen of them on average. See, their assets and liabilities have grown at a very similar rate recently. So I'm putting 6% for both of those. I mean, both of them are larger than they were, so we'd expect a bit of a smaller number. That's why over the past 3 years, you see 50% and 37% because they were pretty small and growing. This isn't a massive company. They're probably more of a mid cap. I know when I was putting in the revenue estimates, I was a few digits shy of some of the other companies that I've looked at. So they definitely got room to grow and aren't a massive player, but are on the rise. Dividends, 5%. I mean, it's got to be at least 3%. If these are true, they've got some more raising to do. So 4, 5%, somewhere in there for the dividend, which will put their yield on cost. If you bought today, if they continue with 4% raises for the next 5 years, you got a yield on cost of 6.4%. You'd be getting paid out $2 per share, which is not bad. And then margins, I'm just saying they hold flat. There might be room for them to cut costs, but it's fine if they don't. I mean, 69% is a really good margin, so not too much to worry about on that front. And then we have down here, so in 3 years, based on all these estimates and the current fair value, we'd say in 3 years, the fair value would be about $52. And in 5 years, it'd be almost 53. So you can see that small growth you're getting because the revenues are coming in so small. If they can come in higher with, say, 5%, you're getting a bit more separation. And then if the revenues are growing at 5%, the dividend's got to grow at least 5%. We'd want the cash flows to grow in line, if not more. So it's all driven by those revenues, and that's going to be the main lever that they have to pull here. Because there you go. Making those adjustments got you up to 3%. Now you're looking at $53 and $54. But the majority of your money is going to be coming from your dividends. And I believe I have dividends factored in here. Yes, I have dividends factored in for your profit. So it says your gain is 84% in 3 years, but really, I mean, you're going from, but if it does achieve its fair value, 25% of your gain you're getting through dividends as well, which is pretty nice, especially since I believe they have a more favored tax rate as real estate investment trust. So if we just look at some of the trends here, revenue, super strong trend, definitely slowed down. I need to dive into what analysts are thinking for why they're only seeing 3% hikes. I know that there's been a lot of deals and acquisitions and partnerships that VICI is doing, so I think that they're going to come in higher than 3% revenue growth. We see good trends here as well. I mean, a bit of a dip down in 2022, if you look at the longer trend for their EBIT, which is probably the most important number here. But you see strong gross profit growth, really flat from 21 to 22 in net profit. So they definitely had some acquisitions going on in that 2021, 2022 timeframe and are seeing the benefit of all of that as of 2024 and beyond. Balance sheet, no complaints here. We actually have tangible assets and we have a tangible book value larger than the liabilities. So this is what I look for in companies. Really good growth in the free cash flow. It is leveling out quite a bit. Not too much of a surprise. I mean, they'd have to acquire some more properties to really have an impact and get their cash flows up. Dividend, super strong growth there. I mean, there's nothing that I really hate about this company. I know a lot of the time in these videos, I'm nitpicking and complaining about things. I hold 100 shares of VICI because I want to sell covered calls against it and collect those dividends. And I think in the portfolio it's in, that's like 7% of that portfolio. I mean, I've got like 4 or 5 different portfolios, but that one's focused on dividends. So we can see balance sheet is far above and beyond anything else. It's amazing for this company. I mean, I don't know how many times I have to say it. I really like their balance sheet. Their cash flows, super strong too. Just great linear growth that we're seeing in cash flows, in the fair value, in the dividend. A little bit of a dip in the earnings back in 2022, but they're just on a linear trend since then. And you can see the actual share price just right down here, not really going along with the fundamentals of the company. I mean, in 2022, it was great. The share price was spot on with the fair value. The dividend was right there too, so it was like the ideal dividend stock. But then as time goes on, the fair value is rising because the balance sheet's getting better, the cash flows are growing stronger, but the share price is staying pretty stagnant. I know part of that has to do with the fact that every time they pay out the dividend, that value comes off the share price, of course. But still, there's some upside here. And with the recent dip across the market, it gives an ability to capitalize on it. Because it's not very often that you see the share price being the lowest valuation of all of our valuation metrics. It's pretty obvious that this one's undervalued in every way. So, I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.